All right, good afternoon, everybody. Chris Lester here, weekly chat with Chris. I want to thank each and every one of you for taking time out of your busy schedules to hop on our weekly calls. I have been doing these since just about 18 months now, since COVID first hit. And obviously, I see a little bit of a resurgence. So, hey, this may be the norm on a go forward basis. But for those of you that have not been on this call before, typically these calls are about 15 to 30 minutes. And we speak on some topic financially related. I do have an idea that I may start to roll out as well, maybe spotlighting a low business or a small business, but that's still in development. What we have been doing is on a monthly basis, doing a sort of Monday day quarterback reflection of what the markets did last month and what are the signals after, not the day to day, what do we see right now, the micro, but sort of a little bit more of a macro view. And what do we see coming? And should any adjustments or caution be given? So nothing will be sold here. Leave your wallets at home, leave your checkbooks at home. Feel free to reach out to me. And there's also a lot of advisors on here from across the country that may invite their clients. Feel free to reach out to them, ask them the questions, or if they don't know or you can't reach them, then certainly reach out to me. So this is the July market update. I know we're into August, and like I said, it is always a month behind. It's just telling us, hey, what do we see? So on a monthly basis, right? So from the June 30th to July 30th, 31st, across the top, you see indices, right? So these are the equity markets. Now, the black line across going horizontal left to right, 0%. And we say, who are the winners? For 1 month, it's the black line, right? Did a little over 4%. That's real estate. And then in a close second, tied for second and third would be, the spider golds. So there's still a little bit of optimism going towards gold. And then the S&P 500. And then we can still see we had some of the commodities and developed countries and European countries, right? The losers were the small caps. Typically, your day-to-day operations, 2 to probably 1,000 employees, corporately sized. Not a great month. Makes sense since some of them were now being told that mass mandates may be in place. So, there's just still a lot of uncertainty. And again, this is just a 1 month snapshot. How does this all look when we take a step back and we take a sort of a pullback? Well, now we can see commodities are way out in front, right? 30%. Things are just, this is a sign that inflation is trying to creep in, right? It's saying that we want more money for the commodities, your coppers, your precious metals, it's heavily oil, petroleum based, that index. So, and the next is real estate. Again, compared to last year, makes sense because real estate really took it on the chin. So now it's coming back with a tear. But the S&P, your blue chips are third so far year to date. So that is good news. Halfway through the year, above 15%. No, I'll take that all day. And then right behind the small caps. Although you can't look at that 1 month snapshot, we can see some volatility in that arena there. And then we have those developed countries and European nations. And then you see, the pink lines, which I typically relate to underdeveloped countries. I like to call it China. And then you see there now gold, which looked good for the month, is still down for the year. So, it was the place to be last year. It's still not back to even, but it seems to be making a run again. So now we look at this chart, which can be a little overwhelming. And when you look left to right, there's 3 indicators, right? So this is the relative strength index, the RSI. So it's anything in between here, overbought, oversold. And right now, nothing's triggered it. You can see that vertically, we have red lines and green lines. And red lines, this is in 2000, internet bubble burst. This is 2007, 2008. This is the housing bubble burst, right? We had a couple, little triggers here along the way. We had a head fake last year when COVID hit, but we still see an upward trend right here. Now, this middle indicator, the one that we're seeing right here, this is the moving average crossover index. And so right now, again, we're seeing positive upward trends. Nothing has caused us to pause. I know that I've said on the first and towards the second quarter, let's watch out for third quarter. I still feel that way. but I am not giving any guidance right now to pull out of the market. Actually, I have clients that, have rolled money over that were dollar cost averaging into the market, right? So it's just taking steps to be in, take availability of the upward trends without overly exposing ourselves should something like Afghanistan happen or a resurgence of COVID. I mean, there's so many variables that on a day-to-day and on a news basis can cause the market to get spooked, but the fundamentals in and of themselves seem to be still pretty solid. And then you have the MACD, moving average convergence, divergence, which all of these still indicate an upward trend. Now we're going to switch over to our income-based assets. So July, on a month-to-month, actually 20-year treasuries took the day. But I want to point out, when I say took the day, 3.5% versus 7-year treasury, 7 to 10-year treasury bonds, right, or bills. So you got 2%. And then if you get into the total international bond portfolios, to be in anything US based, you're at 1%, maybe 0.5%. Everything seemed to be on the positive. But I point out here, when we go to the next slide, that the world is still looking for yield. And if right now you look at the winner is the high yield muni bonds. So these are governmental high yield. When I use the word high yield, supplement that for junk bonds. And then now right above 2%, so about 2.5%, is your high yield corporate bonds. So the high yield, because everybody, as I did towards the beginning of this year, I did my whole presentation on the hunt for yield, the milk cow. This is evidence. So let's just put some math to this. Let's say that you had $1 million that you retired with, and you needed that $1 million to generate income for you. That $1 million, right, if we were to put it into an income fund, a yield fund, right, with to reduce the risk, so something like a normal muni bonds, maybe 1.5%. So you might be getting $10,000 a year not eating into the principal. If you chase the aggregate bond, you'd be actually getting less than that. You'd actually be losing money plus the risk. It could go down in values. I point that out because a lot of times people, as they enter into retirement, they were said, oh, well, I need to have that portfolio. I went from 60-40 and 60% equities, 40% bonds, and now I need to be 60% bonds and 40% equities. Well, this doesn't support that theory. That can actually be a dangerous theory. And we like to just help make sure people have more of a well-rounded, well-thought-out plan. So the bull bear indicator for the aggregate bonds, we still have a green light here, right? So everything is saying that, hey, right now, although there's a lot of noise in the background, nothing has caused this to trip red yet. So on the bond side, although I've been skittish of bonds for several years now, it still isn't the worst place to be. I just think that bond alternatives, as I've talked about in the past, are highly suggested. And again, anybody that's on the call that was invited by another advisor, feel free to circle back with them. So I like this index, but this is something that I took notice of. So this is a recession probability analytics tool. This is a proprietary tool that was created by Formula Folios and now Brookstone. And basically last month it was 2019. And so right now, let's just start with the bad news. And that is it went up, went from 2019 to 26. But 50 is where you're saying, hey, my house is on fire, be careful. There is no warning of further recession at this time based on this sort of calculator that predicts the future using 100 variables, everything from gross domestic products, sales, CPI, inflation, housing starts, a whole plethora of indicators they put in to come up with a calculator to basically say, hey, when we see things on the horizon, it will prompt us. And this did go above last year when COVID hit, did go above 50, and then it started to tail off. So we were very in tune with that. So I like that, and it was just good news. So I want to end this call on a good note. And the last thing I want to say before I hop off, well, let's just make sure I go through my disclosures and my thank you. So next week we have another call talking about gold in general, and then it will be the first week in September. It will be, I think, the only call that I do in September. But if you recall from last week, I said that I would be emphasizing life insurance. And that's because September is Life Insurance Awareness Month. But I will be doing a 10-minute lesson on life insurance. I've done it in the past. I think it's an important message. I think it's, things that in a COVID world right now, I've seen a lot of things happening out there in the underwriting world that I think folks need to be aware of, what you can and should be thinking about. But it's just an educational piece, just how to think or understand it a little bit more simply. But then the next 3 weeks in September, I'm back to traveling. So I'm either going to be in Vegas or I'm going to be in San Diego. I think I'm in Kentucky at an event. So I'm going to be traveling. So for September, the only call I'm going to be doing, I think, might be towards the end when I get back, which will be August update. So we'll see after school starts, what the economy is doing. Hopefully things have settled down in Afghanistan as well, and COVID has not, really just spiraled out of control. So folks, I really want to thank all of you for being on this call today. The fact that you're here each and every week makes it so that I'll be here each and every week. And if I can do anything for you, just please reach out, let us know. We're happy to help. And again, don't keep me a secret. That's the one thing I would ask is, if you're finding these calls valuable, invite a friend. That's how you can really just pass a word. 15 minutes, 20 minutes on a Thursday, say, hey, just send us their email. We'll send them an invite. If they can get some value, great. If not, then, no harm. But we appreciate you not keeping this a secret. So everybody, have a great day. Stay well. If you need us, reach out. Bye-bye.